Great, welcome everyone. So I'm Roli Jain, and thanks for the intro, JP. I'm actually really excited to do this presentation because I think it's my favorite topic to teach. Because I think a lot of you have learned a lot about option theory and perhaps a lot of strategies, but applying it in real life and knowing where to start is kind of where the juice is. So I am really excited to do options in action, and I'm going to teach you how to implement tradable ideas. So let's get started. So today's agenda is we're going to learn how to enter into a directional trade using an outright call purchase. First step, I've developed actually a 5-step program. First is finding a name or security to trade in if you already don't have one. And then there's determining factors. Can you actually implement this option strategy? And then after you've determined that, then step 3 is analyzing the strikes and expiration dates, followed by analyzing the cost of the trade, and with the final selection of which trade you're going to enter into. And it's really an art and a science that I'm going to go through. The last step is setting up the position and executing it. I will then, which is very important, I'm going to go over how to manage this position until the expiration date, followed by overall best practices. First of all, can everyone hear me okay? They can see me, they can see the presentation? Great. Okay, so before we begin, let's do a recap. Most people are allowed to trade calls, buy puts under the registered accounts. You want to know the risks associated. So let's recap real quick. What's an outright call purchase strategy? Generally, buying puts and calls are permissible in your account. So here, your motivation as an investor could be wanting to participate in any upside on a security that you may have a bullish view on. The problem is that stocks can be very expensive, and that is where buying outright calls fit the bill and allow you to participate at a fraction of a cost. Recall that this trade will be profitable if the underlying stock is trading above the strike price by the expiration date. Otherwise, the call option expires worthless. But your risk is limited to the one-time upfront cost you've paid for the call option. Note that you can also close this trade anytime before expiration. That I'm going to cover under managing the trading section later. So that's where to begin. Some of you may have an idea of some names that you're interested in, but for those who don't, let's start finding a name that turns into an actionable trade idea. This is actually what I did at TD, at JP Morgan, working as a broker dealer in New York, and probably my favorite part. So let's start with a few resources that you have available to you. So what's resources such as seekingalpha.com, benzinga.com, fool.ca, BNN. You want to capitalize on current events as well. These are all places where you can find what's happening in the market. Is there certain names that would be a good idea to enter into? Maybe it's something where you want a long-term goal or a short-term goal. Also looking at most active options traded. So you can actually see the daily volume every day on Montreal Exchange website, which options have been heavily traded on under which name, which is a good indicator, hey, something's happening in the market. Also, then we have the penny name list. For those who don't know the penny name list, 80 names or a quarter of the option classes in Canada are under the penny name list. And that's basically if you have an option with a bid-ask spread, you can actually, the bid-ask spread, you can enter a price in increments of a penny. Generally, you see a nickel or a penny. And what that does is it permits investors to trade options at better prices. It is for options with premiums less than $3, with the exception of a few ETFs, popular ETFs, XEG, XFN, XGD, and XIU. So that's food for thought. Also, what are people trading? This is a great way to see the heavy option names that are trading in the market. So here we go on to Montreal Exchange website, and on the home page, you'll see trading activity on the right-hand corner. And you'll see the top 10 or top 15 names traded and the total volume traded. So that's the total calls and puts traded, regardless if they're buying or selling. So let's say we're interested in defensive stocks for now, and Enbridge looks like a good name. We want to add that to our portfolio right now. We see a volume of 572. Okay, great. So maybe we'll go with Enbridge. What's the next step? Let's see. Before we go there, we actually want to look at the trading chart to see if it makes sense for our personal view. So we had a drop due to COVID. So we're capitalizing on this 30% market drop. And we're hoping that there is some room for it to rally back to its old levels in December. So we go for it, we think it's a bullish view, and maybe as an investor, for example purposes, we believe in the next few months or the next 6 months tops, we will see a rally in Enbridge. Great, next. Now let's see if this trade or this option strategy is feasible for the name for Enbridge. The determining factors would include, first you want to decide, well, do I want to trade this option on the Canadian or the US market? Then you want to look at the actual options market, what's the option chain available, evaluate the bid-ask spread and size, look at the trading volume on the option side, and then finally analyze the richness of the option. So first, the Canadian versus US market. As I said, a third of the MX options are interlisted and traded on both US and Canadian market. Now, I know there's a lot of investors that may rush out to trade on the US market thinking that it may have higher liquidity or better liquidity. But in fact, actually, Options Play did a analysis on the front month at the money options and found on average that on the Canadian names, the average spread is 43 cents in CAD. And for US, it was $1.03. Now note that the actual average size is much smaller in Canada. However, 50% of the investors in Canada are retail, and usually retail investors do have a smaller size that they trade on. So again, it depends what your objective is. For this example, we think we're going to trade probably less than a few contracts, so it makes more sense to trade on the Canadian market. Also, you want to consider exchange rate differentials. Okay, what does the option chain look like? It's always good to take a peek at the option chain and what is available. And you may not be sure which strike price, which expiry date you want, but you may have a rough idea. So also, it's nice to see weekly options. Obviously, those are options that are expiring in a week. And they're great for short-term investing if you believe an event is about to happen. So let's scroll through the options chain. Again, this is available on the Montreal Exchange website on the quotes page. And as we can see, there's weekly options available. We have options expiring in the next 3 months. We have September, October, January, and leap options expiring in 2022. And I can see strike prices out to 10% available. So do I feel there's sufficient chain for my purposes to evaluate? Yes. Also note, this option chain data was taken as of mid-August. Next is option total volume. So what you want to do is there's a kind of a rule of thumb that you look at. Are there enough contracts traded on a daily basis in order to consider if a name is liquid enough in the options market? So for US names, it would be 1,000 contracts that would be considered to be liquid. For Canadian names, it would be considered 500 contracts. Now, as we've seen, the Enbridge volume as of August 14th, the total volume was 682 contracts traded for the day. So is it sufficient enough for us? We think there's enough volume on the option side? Yes, it is. Next, bid-ask spread. A lot of you may understand this concept. For those that don't, this is where you have a market maker. And the market maker is quoting a bid-ask spread for the actual option chain or specific option series. So this is where if, for example, you have a bid of $2.50 and an offer at $3.10, this means that they are willing to buy the bid for $2.50 and they're willing to sell $3 at $3.10, meaning you as the investor is willing to sell at $2.50 to them, and you're willing to buy from them for $3.10. You also want to look at the spread here. If it's too wide or narrow, and here it's 60 cents, and it depends how much the underlying stock is trading at, and then you'll evaluate it based on that. The next thing is the size on the bid ask. So that here you have the bid, say for example, times 30. The offer has times 4. What does that mean? That means that, say, a collection of 30 contracts are available to buy from you for $2.50, and in turn, you are able to sell 30 contracts of your option series at $2.50. The offer side means that someone is willing to sell 4 contracts at $3.10 to you right away, and you're able to buy 4 contracts for $3.10. Let's look at Enbridge now specifically. So if you don't actually have a specific strike price and expiry date in mind, what I like to do first is, before you dive in, I like to look at the bid-ask size for say a 10% out of the money call option expiring in the next 3 months to kind of look at the liquidity. So here we have it. The bid-ask is ranging between 11 cents and 17 cents. That's a spread of 6 cents. Do we think it's sufficient? Yes, we do. Now let's look at the size. We have 115 by 65. What does that mean? You can sell up to 115 contracts at 11 cents, and you can buy up to 65 contracts for 17 cents. And again, you want to consider, well, how much are you willing to trade right now? I think for this example purposes, we're going to be trading 1 contract. Are there enough buyers and sellers? Yes. Richness. This is the last factor for evaluating richness. So when you sell stocks, you want them to be trading high, and when you buy stocks, you want them to trade low. Options work the same way, except by evaluating volatility. I think you just learned about volatility in a previous session in covered calls. So when selling options, you want volatility to be expensive. And when buying options, you want volatility to be cheap. For the outright call purchase, you want to determine if implied volatility is trading cheap relative to the historical volatility. Basically, you want to see if you're getting a good deal for what you're buying. So I'm going to teach you a really quick and dirty way of how to eyeball cheapness with the data that's available to you. Many of you may not have access to Bloomberg, for example. So we're going to use the data available on, say, Montreal Stock Exchange website. So you go to trading quotes, and we're going to compare the implied volatility to historical volatility. So first, we're going to look at the historical volatility available to us. We have the 30-day historical volatility available for Enbridge, which is 21.43%. Now we have to look at a very similar implied volatility that's choosing with the same time frame at the money strike and option chain that has liquidity. So here we're going to choose for a weekly option series expiring in September and the actual monthly option series in September. We can see that the implied volatility is less than 21.43%. Again, this is a very rough measure. I want you to note that this implied volatility can be high as well if there's expected news happening, or for example, earnings, as you learned earlier. So this is kind of a very rough measure that you want to use as. And generally, traders, they compare the 3-month historical volatility with the 3-month at the money implied volatility, given they have the data available. So for this purpose, do we feel that this is cheap enough, or at least it's not expensive? Yes, we do. So we're done with determining factors. We're ready to go ahead and select the strike price and expiry date. So now we're going to, now this is very much of an art and a science, where it can be based on a lot of different things, where it could be based on technical analysis, could be based on fundamental analysis or target prices, expected volatility or news or earnings, for example. Also, what is your view? Is it short-term? Is it long-term? And at the end, you want to be flexible enough in your selection, because then at the end of the day, it's going to depend on the cost of the trade. All right, so if you don't have an indication, I like to first look at the chart. So here's Enbridge's chart. I have plotted the moving average, 50-day and 200-day average. They are trading indicators as support and resistance. And what I'm just going to look at, something very simple, is I know where the at the money is, 5% at the money, and I'm looking at 10% at the money. So I have $46 and about $48. For our example, I'm going to focus on these strike prices. Now, you want to select expiration days. You want to think about events coming up, if there's any expected news, or if there's something happening in the market that's going to impact this individual stock itself. I think we've seen a lot happening this past year as it is. Excuse me. You want to assess what is the probability of Enbridge rallying over 5 or 10% by the different timelines. Note that there is also a tool available on MX's website. It's called a trade range simulator through Option Play. It's based on a historical price distribution. So it gives you a theoretical trading range based on historical movement. Also, you want to be thinking about cost. So obviously, as you go out further in time, the option will cost more for that reason, because you have more time for Enbridge to rally. And the probability of Enbridge rallying, given a more amount of time, will be higher. So obviously the cost is higher. So for our purposes, we're going to select, we're thinking in the range of October or January, that we expect between 3 to 6 months, we can expect Enbridge to move. Now we do the final selection process. Here, what you want to look at is the cost. And this kind of goes back to the volatility. And it's looking at a cost. What you do is you take the premium or the cost divided by the reference price, the price of where Enbridge is trading, and you look at it as a percentage. So here I actually have a cost based off of the actual, using the last price and using a mid price of the different options available. And we're interested in October, in January, for 46 and 48 strike prices. So here the cost we see is ranging between the 48 call options are obviously costing less than the 46 strike prices, and the January options that are expiring in January cost more than the October options. Now what you want to look at is also the risk reward profile. That is, what is a profit you're going to earn given the risk that you put in? And I have two analyses there. The return if stock increases by 5% and if it increases by 10%. So what I like to look at is the mixture of how much is costing us and what is the output that I'm going to get? How much can I actually earn on this? So return if stock increases by 10%. So if it goes to $48.37, currently it's at $43.97. If we enter into an October 46 strike price, we have a 426% return. It's simple return. And the cost is about 1%. Now, this is something, again, where you have to see your own objective, your own risk tolerance, and you have to see how much you're willing to spend. And my personal view is that you shouldn't spend more than 2 to 4% when you're buying, say, a 3-month, 10% out of the money call option. This can be different for all of you. Perhaps you know that you have faith in this name and you want something long-term, so you're willing to pay more money for it. So again, just depends on your objective. For our purposes, I'm going to go with the October 46 strike price. That's going to cost us about 45 cents if I use the last price. And here again is the hockey stick diagram. I'm sure all of you have seen before. I like to kind of look at my P&L and what's the possibility in hypotheticals. So if you can see the hockey stick diagram that my risk is limited to the option premium. My break-even price is going to be the strike price plus the premium. So that's $46.45. And my upside is unlimited. Another thing I like to look at is buying the stock versus the option strategy. So here we know if we buy the call option strategy, buying the 46 strike price, it's going to cost us $45. We're going to use the price of the last price, which was 45 cents. Remember, you're going to times it by 100. Versus buying the Enbridge stock outright would cost us $4,397. So let's look at what happens if Enbridge stock decreases. So if it decreases, you can see by 5%, 10%, 20, 30, the loss of the option strategy stays at $45. And I think that's the beauty of it, that your loss is limited to the premium of the option. Now, if the Enbridge stock increases, I really love this chart because I think the picture says it all, where you want to calculate the simple return comparison if the stock rallies versus if the option strategy is implemented. So if the stock rallies, say, to $51, and if you just bought the stock itself, you would make about 16% versus the option strategy is just over 1,000% return. And I think that's the beauty, that is leverage right there in front of you. So let's think about it. Setting up the trade now. The things you want to consider is first you want to confirm liquidity on this specific option series you chose. So you want to see how liquid it is. You want to look at the bid-ask spread. You want to see if there's a sufficient number of contracts available to buy and sell. So let's look at it. And here we have it. We have a bid-ask spread of 7 cents. So 40 cents to 47 cents. The size is 79 by 10. So looks like sufficient buyers. The spread is not too bad. It's 7 cents. Let's go to the next thing. What are the other things you're going to consider? So there's a sensitivity of the option series. How fast do you need to enter into this trade? You also want to consider the delta. The delta is higher for at the money than a 10% out of the money call option. What that means is the option price will be more sensitive to the underlying price move if, say, for example, you had a $44 strike price. So as you get further out the money, less sensitive delta, the lower delta will be. You want to also consider, is the underlying name moving quickly on the day? I think we're seeing a lot of movements these days, and there's a lot of market impacts that are affecting the underlying stocks as well. So I think that's something to consider. And also another thing you want to consider is, well, what time of the day do you want to enter into this trade? Generally, maybe at the open and just 30 minutes before the close. You may not want to enter into a trade right away. The stock is rallying a lot. That's where I like to look at stock charts and kind of do a little bit of analysis on that. And then you want to see, are there current events that will be happening that can impact the market? Also, you want to set your limit price. You want to look at the last price versus the mid price. So the last price is where it was last traded at. And the mid price obviously is between the bid and ask. So you want to think about where you want to actually enter into this trade. Is the price more on the last price more on the bid side or on the offer side? And you know, if there are penny increments available. And also, you don't want to lose out on this position over a couple of pennies as well. So here our strategy for this trade is going to be inputted 30 minutes after the open. We're going to choose to put the limit price at the last price of 45 cents and make this a day order. Here we have the TMX trading simulator. Many of you may have seen this. And we're going to choose, make sure when you're doing this, you are choosing the right call option because there could be multiple years, or maybe you're choosing a weekly one. So make sure you're choosing the right one, the right series. So here we have the Enbridge call option expiring in the monthly option of October. And I think JP just actually added the link to the simulator as well. Thanks, JP. And here we have, right now it's showing us the live bid and ask, which is 40 cents to 47 cents. And here we're going to put in a limit price of 45 cents. You guys are subject to transaction costs here. So for this purpose, it's $9.95. I think I pay way more than that. And so here, total order is $54.95. And you execute it. Hopefully you get filled. You want to also manage the trade if you're not filled. You want to think about how the stock is trading. If the stock is moving in your direction, or if it's moving higher, then you know the cost of your option will become higher. So maybe you think it's going to have a pullback in a couple of hours or whatnot, then you would wait for it. So it's something you want to manage, and kind of, you know, know what your limits are and know what how much you want to spend. Okay. Now you're not done. You have entered this into the position, but really what is important is what are you supposed to do now? Your position is live. You have to be able to manage the trade until expiration date. So what do? We have a textbook way, everyone knows this. If the stock is trading above the strike price by expiration date, then you can choose to exercise the call option by the expiration date. That is buying 100 shares of Enbridge for $46. Here the pros is, okay, you enjoy the profits, benefits of stock ownership, such as dividends. Now the con is this transaction costs. For example, it may cost $50 to actually exercise, the cost to exercise. And you have to have the funds available to exercise, meaning for this example, you would have to have $4,600 available in your account to allocate. So let's look at what happens in the real world. This is the practical way. So you can, like I said, you can close the trade at any time before the expiration date. Say if the stock rallies, you don't have to wait until expiry, since the call option is going to have more juice and volatility. Now, if you remember, a option value is comprised of intrinsic value and extrinsic. Intrinsic is basically how much in the money it is. So for example, if the stock goes up by $5, that $5 between where it's trading at and the strike price, that's your intrinsic value. Your extrinsic value is going to be the extra juice, what we call it, or extra volatility. And that's basically what you're trying to manage. And remember that you have to remember time value, that as it's going to get closer and closer to expiration, it's going to lose that juice that it's going to have on an exponential level. So some considerations you want to have is setting up alerts on the call option, as well as on the underlying name. You don't want to wait also until the very last minute of the expiration date, since liquidity could dry up. So you don't want to wait Friday afternoon or so forth to get out of this trade. It could be very hard, and then you're paying more for it to get out of the trade. And like I said, don't forget time value. That's very, very important. You want to capitalize on market movements or economic situations. Remember that volatility, when there's volatility, it's going to increase the value of your option. And even if the Enbridge, maybe it trades just below $46, but there could be something happening in market that it increased the volatility and the actual value of the option. And there's still a lot of time value to it. And the value of the option is higher. So it really depends on that. And that's why you don't want to set up limits in advance that you want to close this trade if, say, it's trading above a certain number, because the option price could change dramatically. Best practices. So first thing is you want to get the commissions cost down. You may want to buy every few months, and that's where you're going to decide, well, do I want to buy something 3 months out? Do I want to invest in a weekly option as well? You want to see how you want to spread your capital across several names. You want to look at the position size. So how much are you willing to risk dollar-wise? It can get very, I can see it getting out of control for some new investors where it is a great strategy and you're implementing the strategy for a lot of new names. But if you're, remember, you're still risking this dollar value according to whatever the option is costing. So keep that in mind. Also, are you expecting to make a certain percentage, or do you really want to have stock ownership benefits? Also, another thing, you want to see how risky is the name you're investing with. For example, maybe you want to start with defensive names or high quality stocks. And if volatility is low and the cost of option is at a fraction, then it makes sense. Now, the name you want to see also, if the name has dropped in a price, it creates an entry opportunity. What that means is, we did see it during COVID, during March 2020. Market collapsed, a lot of everything collapsed, but there were some names that may have collapsed more than it should have, or perhaps it didn't make sense because they were high quality names and it's a name that you believe in or that you've done your homework on. So maybe that was a great entry point to enter into a trade then, and that's what we call entry opportunity. Also, if you're holding onto a call option, like I said, don't wait for expiry to close out your position, and don't wait for time decay to kick in. And lastly, don't be greedy. So that's the end of my session, and I am ready for questions from the audience. I do see one question from Quinn. Is there any research report Enbridge is going to increase their gas price in October? I think that's, again, you have to do your homework on this, and I think there's a lot of stuff available online. You have to look at the resources that are available to you. And I'm just going to go to my Q&A box. Give me a second, guys. Okay, I think we have a lot of questions here. Okay, great. So we have an anonymous question, finding ideas. Shouldn't we be looking at technical support resistance, rather looking at trading activities? So when I was speaking at trading activities, I did mention that with the trading activities, you're looking at option trading names. So if you're not sure which names to look at, because there could be some names that aren't very liquid in the options world. So you may want to look at the most traded names on the option side. So that's what it was referring to. And again, you should look at technicals, look at fundamentals. You should do your homework before you get into this. Okay, next one. What are your thoughts on trading only premiums and never execute the options? So as I said, you're paying a percentage. When you're buying a call option or buying any option, you're paying a percentage. You want to think about it, how much you're paying versus where the stock is trading at as a reference price. You don't want to pay more than a couple of percent or 3%. Executing the options, there is higher transaction costs. And like I said, that is the textbook way. Again, it depends on your goals, what you want to do. Okay, so how about selection strategies for selling options and maximizing premiums? That's another session, which I would love to get into. That's selling options. As you know, you are collecting premium. And I'll quickly tell you, if you're selling puts, that's an entry point to get into a name and you can enter it. Yes, that's an alternative strategy. Okay, 1 second. How about, okay. What would be the example case where you want to buy stocks over buying options? That would be honestly where you want to have stock ownership, where you want to enjoy the benefits of that. You have a very long-term view or unknown where you're not sure what's going to happen with the stock. And you also have the capital to enter into a stock. That's when you would choose buying stocks instead. Okay. So a 10% out of the money will have a much lower delta than in the money. I chose 70 delta regardless of the cost to buy the option and set a stop loss to protect loss. Out of the money means really the stock really has to move because of the lower delta. Yes, it has to move. Now, this is where you also want to analyze, like I know I'm repeating myself, but you want to analyze also how much you're spending on this call option. That's okay if you are choosing a 70 delta and you're not looking at the cost, but I would also look at the cost, and you want to think about the stop loss on, on the actual option series. So this is where you have to manage the actual option, and you have to see, well, where is the underlying moving as well. Okay, I think we have, can we place stop orders? No, I think that's a different one. Okay, here's a question. When you buy a call, if the stock goes higher and you sell to close with collecting profit before the expiration, question is, who pays you the profit that you made from rising stock? Does the market maker have to buy stocks or equal quantity to cover your options position? So this is going to work the same way as, think of it when you buy stocks. And again, here the question is asking, well, what happens before the expiration date? So if you're buying something, say we bought it for 45 cents and it starts trading, say this option after after a month, it starts trading at $1.02. Then that profit, you're gonna actually close out of this position just as you would close out of a stock, pay the transaction fees, and that's the money in your pocket. That's essentially it. The market makers are the ones that are pricing it and giving you that price. Hey, this is now worth $1.02. That's where they come in. All right. Scrolling through the questions, guys. I see some questions on exiting and setting up stop losses. And this is where, again, what I like is setting up alerts on where the option price is trading at and the actual underlying, because the option price can vary significantly based on volatility, and you don't want to miss out. So you really want to kind of keep an eye. If the stock trades at a certain level, then you maybe want to close out of the position. So I would look more of that. All right. Can we sell covered calls on leap options? So again, you want to think about, this is not on covered calls, but it's the same theory. You want to look at the option chain available. You want to look at liquidity. So you would look out to 2022 and you would see if there's any, how the liquidity is. And sometimes it is scarce out to that level, but there may be some names where it's not. And obviously you're going to be paying more to leap options. All right. Okay. What is the best time frame for options, weekly, monthly, or very long time? This goes in again where weekly, you're obviously going to be paying a little bit less. But the thing is, suppose we had chose a call option that was expiring in 2 weeks and the cost of it was perhaps maybe 10 cents. So here you're still losing out on that money that you're putting in. You don't want to blindly just invest for the sake of investing. You want to see that, okay, I do have a short-term line. I feel that the probability of this stock will go up in the next 2 weeks. And maybe you're expecting some news as well in the market that you think will have an impact, then maybe it makes sense to spend a little bit more and that your return will be higher. Okay, I think I'm going to take one more question and then I'm going to wrap up. Okay. Okay, I think I have the similar one. Okay, last question I'm going to do. What is your advice on trading very volatile names? What you want to think of, if you're paying, remember, with volatility, the price of the option will be higher. So think of it this way. You want to look at the risk reward profile. That is, look at what profit you'll earn over what you're risking, which is the cost of the option. Does it make sense? If you're paying 10% for something and your return is say 20%, but the probability of the stock rallying to those levels is much lower, then does it make sense to you to actually enter into this trade? So I'm gonna stop there. I'm gonna hand it over to JP. Thank you everyone for listening.